All right, let's start with a question. What if I told you that the single most important person for your company's success isn't your CEO, not your top salesperson, not even your biggest investor? What if it's a central banker you'll probably never even meet? Now, as a future business leader, you're being trained to master strategy, operations, finance, the whole shebang. But outside your boardroom, there's this incredibly powerful force that can make your best-laid plans look either brilliant or, well, completely irrelevant. And that force is monetary policy. So let's just forget the dry textbook definitions for a bit. For the next 10 minutes, think of this as your essential strategic briefing on how to read the currents of the economy before they turn into a tidal wave.
So let's frame our entire conversation around this one critical question. When it comes to your business, is the central bank a friend or is it a foe? The honest answer is it depends. It changes with the economic seasons. It's your absolute best friend when it's flooding the market with cheap capital, making that billion-dollar acquisition or that factory expansion a total strategic no-brainer. But it can become your toughest opponent when it decides to jack up interest rates, turning your profitable new product line into a money pit right as consumer demand just vanishes. So understanding its motives, its tools, and its playbook, that isn't just some academic exercise. It's a core competency for survival and for sure for success.
So here's the game plan for this explainer. We are going to completely demystify the world of central banking. First, we're going to look at the central bank's role as the economy's conductor. Then we're going to crack open its powerful toolkit to really understand the levers that move markets. After that, we'll run through two totally opposite scenarios. One where they're slamming on the brakes to tame inflation, and one where they're hitting the gas to spark growth. And finally, we'll connect all the dots, tracing those invisible strings that link a policy decision way over in the capital directly to your company's stock price. To really get a handle on this, let's start with a powerful metaphor. Just imagine the entire global economy as this massive symphony orchestra. You've got a million different instruments playing all at once. Some are loud, some are quiet, some are super fast, some are slow. It's complex, it's chaotic. Now, the central bank, it isn't playing a single instrument. Nope. Its job is to be the conductor, standing up there at the podium, guiding the tempo, the dynamics, to make sure the final output is this harmonious melody of stable growth and not just a deafening crash of booms and busts.
And this conductor, they don't just make it up as they go. They're following a very specific score, a mandate with three core objectives that really act as their North Star. First up, price stability. For your business, this is the absolute bedrock of planning. It means the cost of your steel, your software licenses, your labor, it isn't going to suddenly double overnight. Second, you've got exchange rate stability. If you're sourcing parts from Vietnam, or selling software in Europe, or competing with imports from China, a volatile currency can just wipe out your margins in a heartbeat. And finally, growth with social justice. Now, this isn't just some feel-good phrase. It's about creating an economic environment where companies like yours feel confident enough to invest, to expand, and most importantly, to hire people.
Okay, so how does this conductor actually guide the orchestra? Well, they have a powerful set of tools at their disposal, and for a business strategist, understanding these tools, it's kind of like having a crystal ball for the economy. It lets you anticipate their next move and position your company to either ride the wave or, brace for impact. So let's open up that toolkit. The first and probably most famous tool is the repo rate. The easiest way to think about it is this. The central bank is the bank for banks. The repo rate is simply the interest rate that commercial banks, your bank, pay when they need to borrow from this ultimate source of funds. It is the foundational cost of money, the wholesale price from which pretty much all other interest rates in the economy are derived. Seriously, every time the central bank's board meets, the entire business world holds its breath, just waiting to hear what's going to happen to this one single number.
And this is where it gets personal for you and me. That decision, made in some quiet boardroom, starts a massive chain reaction. The central bank tweaks the repo rate. Instantly, the cost for a bank like JP Morgan or Bank of America to fund their operations changes. And trust me, they don't absorb that change. They pass it on. That rate change quickly shows up in the interest rate on your company's credit line, and it also hits your customers' wallets through their mortgages, their car loans, and their credit card debt. It touches everything. Let's make this super tangible. Imagine you're a corporate finance manager. You've got a $50 million factory expansion on your desk, and it's projected to have an internal rate of return, an IRR of 10%. Your company's weighted average cost of capital, your WACC, is sitting at 8%. So hey, this looks like a great project. But then, the central bank raises the repo rate. Your company's borrowing costs tick up, and that pushes your WACC from 8% to, let's say, 9.5%. All of a sudden, your project's positive net present value flips negative. The hurdle rate isn't met anymore. The project gets shelved. Jobs aren't created. Future growth is lost. That's how a tiny change in monetary policy can have a massive, real-world impact on your business. Now let's flip the coin. What if the central bank wants to take money out of the system, but maybe without raising rates too aggressively? That's where the reverse repo rate comes in. You can basically think of it as a special, super safe, high-yield savings account that only banks can use. By offering an attractive, risk-free rate, the central bank encourages commercial banks to park their extra cash with it overnight instead of lending that money out to your business or to consumers. It pretty much sets a floor for interest rates.
Okay, so what about the actual supply of money? Imagine your company has a great quarter and deposits $100 million into its bank account. Now, the bank can't just turn around and lend out that full amount. Nope, a big chunk of it is locked away by mandate. The cash reserve ratio, or CRR, is the slice that has to be kept with the central bank, in this case, 3%. Then there's the statutory liquidity ratio, or SLR, which is another 18% that has to be invested in ultra-safe stuff like government bonds. That leaves only 79%, so $79 million, as loanable funds. This whole fractional reserve system is literally the engine of credit creation in our economy.
And this is why, as a business leader, you have to pay attention to these obscure little ratios. When the central bank decides to lower the CRR, or the SLR, it's like a massive green light for the entire economy. It's like they've just unlocked a giant vault of capital. Billions of dollars are instantly freed up on bank balance sheets, which increases the supply of money they can lend. And what happens then? It forces banks to compete more aggressively for good borrowers, like your company. For you, that means better terms, lower rates, and easier access to the capital you need to grow. Suddenly, it's time to dust off those expansion plans you had to shelf.
All right, now we're getting to the heavy artillery. If the repo rate is a scalpel, then open market operations, or OMOs, are the central bank's bazooka. This isn't about subtle short-term tweaks. This is how the bank makes huge, system-wide moves. When it wants to inject cash into the economy, it just goes into the open market and buys billions of dollars of government bonds from banks, swapping those bonds for fresh, new electronic money. And when it wants to absorb cash, it does the exact opposite, sells bonds and pulls money right out of the system.
If you're a CFO, this is the stuff that keeps you up at night. These massive bond buying programs, they directly manipulate the price and yield of government bonds. And the yield on the 10-year government bond is what we call the risk-free rate. It is the bedrock of modern finance theory. It's a key input in the capital asset pricing model, which you use to figure out your cost of equity. It's the benchmark for pricing the bonds your own company issues. It fundamentally changes your WACC, and by extension, the entire valuation of your company. OMOs literally change what your company is worth on paper.
So what happens when things go really wrong? Let's say it's 3 a.m. and a major bank, through some miscalculation, is on the verge of defaulting on its overnight obligations. Panic could rip through the system by sunrise, freezing up the credit markets your business relies on. This is where the marginal standing facility kicks in. It's an emergency, no questions asked lending window. Think of it as the financial firefighter, the lender of last resort that prevents a single spark from turning into a raging inferno that consumes the entire economy.
So with all these tools in the toolkit, the scalpel, the savings account, the vault keys, and the bazooka, the central bank really only has two basic strategies it can run, two fundamental playbooks. Depending on the economic weather, it will either pump the brakes to cool things down, or it's going to hit the gas to get things moving again. Let's see them in action.
Okay, scenario 1. Imagine the party's getting out of hand. The economy is just overheating. Demand is soaring, supply chains are stretched thin, wages are spiraling upwards, and inflation, that guest that just will not leave, is eating into everyone's purchasing power. The conductor decides it's time to be the designated driver and take away the keys. The goal here is a soft landing, not a crash.
So what's the plan? Well, it's usually a coordinated three-pronged attack. First, they make money more expensive by raising that repo rate, which makes borrowing way less attractive for everyone. Second, they actively start sucking cash out of the system by selling government bonds through OMOs. And third, they might even tighten the screws a bit more by increasing those reserve requirements, forcing banks to hold more cash and lend less. The whole point of this squeeze is to deliberately slow down economic activity to get demand back in line with supply.
You know, a 1.5% rate hike might not sound like much, but in the economy, it's an earthquake. For a real estate developer, that 1.5% increase on a multi-million-dollar construction loan, that can be the difference between making a profit and taking a loss. Projects get canceled. For the auto industry, it means a car loan for a customer just went from $500 a month to $550. Millions of potential buyers suddenly decide to wait. And this just cascades down the supply chain, from steel mills to software developers to the local dealership. That single 1.5% decision can trigger a slowdown across the entire industrial sector.
All right, let's flip the script. Now the economy is on life support. Confidence is just evaporated. Businesses are laying off workers. Consumers are hoarding cash, and a deep recession is looming. The conductor sees the tempo has slowed to a crawl. The central bank has to act, and it has to act fast to prevent a complete collapse.
It is time to open the floodgates. The central bank executes the expansionary playbook, doing the exact opposite of everything we just saw. It slashes the repo rate, making borrowing incredibly cheap. It launches massive OMOs, buying up government bonds and injecting a tidal wave of cash into the financial system. It lowers reserve requirements, freeing up banks to lend as aggressively as possible. The goal is simple: make money so cheap and so abundant that businesses and consumers feel almost compelled to borrow, invest, and spend.
You know, we've all been there. You're stuck in traffic, just crawling along some bumpy dirt road, and then suddenly you merge onto a wide-open, freshly paved highway. That feeling of sudden, effortless acceleration, that's exactly what an expansionary policy is designed to create for an economy. It's about shifting the entire collective mindset from fear and caution to one of optimism and opportunity. It really is the difference between crawling and flying.
Okay, so we've talked theory, we've talked tools, we've talked playbooks. Now let's get to the really good stuff. How does all of this actually translate to the metrics that you, as a business leader, are going to live and die by? How does a decision made by the central bank directly impact your company's valuation and ultimately your shareholders' wealth? Now look, this matrix is obviously a simplified model, and the real world is way more complex, but it gives you a really powerful framework. When the repo rate goes up, two things happen to your valuation model. First, consumer demand falls, which lowers your projected future cash flows. Second, your cost of capital, that's the discount rate you apply to those future cash flows, it goes up. Lower cash flows being discounted at a higher rate, that is a brutal double whammy for your company's valuation. And conversely, when rates or reserve requirements fall, your borrowing costs go down. Consumer demand gets a boost, and your valuation gets a powerful tailwind. This isn't abstract stuff. This is the literal math of modern corporate finance.
So we've established the central bank as this powerful force you have to anticipate. You now have the framework to do that. But this leads to one final critical thought. This entire toolkit we've discussed, repo rates, reserve ratios, open market operations, all of it was designed for an analog, centralized financial world. We are now entering an era of decentralized finance, of cryptocurrencies that operate completely outside the banking system, and of AI algorithms that move markets in microseconds. The world is changing fast, and the old rules might not apply. As the business leaders of tomorrow, it's really your job to figure out how to navigate this new landscape. The future of the economy, it's in your hands.